You're paying more to insure your car, more to insure your home. More coverage is smaller, and your insurer is more likely to say no. So why are Americans paying more for less protection? Start with the basic idea behind insurance because it explains everything else. Insurance doesn't price what already happened, it prices what might happen next. Every premium you pay is a bet on future risk, future repair costs, future claims. When those future costs climb, so does your bill, even if you've never filed a claim in your life. That's the whole engine behind this story. Not greed, exactly. Repricing. Start with your car, because the mechanism is easiest to see there. Modern vehicles are packed with sensors, cameras, and onboard computers. A cracked bumper used to just mean a cracked bumper. Now it can mean recalibrating a camera system mounted right behind it. That recalibration alone can cost hundreds of dollars on what used to be a simple bodywork job. Electric vehicles push this further. Their batteries alone can cost $15,000 to $30,000 to replace. Insurers spent years pricing EV policies optimistically based on early limited data. That data turned out to be wrong. Actual claims came in far more expensive than initial models predicted, and premiums are still catching up to that reality. It's a pattern worth remembering for any genuinely new technology entering an insurance market. The first few years of pricing are often closer to guesswork than genuine risk assessment, since the data simply doesn't exist yet. Add rising labor costs and ongoing part shortages on top of that, and even a minor fender bender now gets expensive fast. There's a less obvious driver too. Auto theft has surged nationwide in recent years. Insurers respond to that the same way they respond to any other risk, by raising rates even for drivers who've never had a claim and never will. Parked cars get stolen from driveways. Insurers can't tell which specific driveway is safe and which one isn't, so the cost gets spread across everyone in the risk pool instead, whether your own car has ever been touched or not. Homes tell a similar story with a sharper edge to it. Wildfires, hurricanes, and floods keep getting more frequent and more severe. Rebuilding costs keep climbing right alongside them, driven by higher material and labor costs across the entire construction industry. In the highest risk zones, some insurers haven't just raised prices. They've stopped writing new policies entirely. Not more expensive. Gone. Homeowners in parts of Florida, California, and Louisiana are increasingly being pushed onto state-backed insurer of last resort plans, often at a steeper price than anything available on the open market before. The numbers back this up clearly. Homeowners insurance premiums are projected to keep climbing through 2026 and 2027, with some states seeing double-digit increases in a single year. California alone has seen some of the sharpest jumps in the country recently. One recent estimate put homeowners' premiums up nearly a quarter over just a few years, driven almost entirely by catastrophe losses and by the rising cost of reinsurance, the insurance that insurance companies themselves buy to cover catastrophic losses. When reinsurance gets more expensive, that cost flows straight down to your renewal notice. Think of reinsurance as insurance for the insurance company itself. When a hurricane wipes out an entire coastal town, the local insurer alone couldn't survive that payout. Reinsurance is what actually absorbs the worst of it, spread across a global pool of capital. But that global pool has gotten more expensive too, as climate-driven disasters have grown more frequent worldwide, not just in any one state. Now, healthcare, and this is where things get structurally different from cars and homes. Healthcare runs on its own separate machine entirely. Hospital costs, drug prices, and insurer negotiations all feed directly into what you pay. Health insurance premium increases used to be so routine that an 8 to 12% annual jump barely made headlines. This year has been sharper than that in many markets. On ACA Marketplace plans specifically, the picture is genuinely brutal for a lot of people. Benchmark premiums have risen over 20% this year alone, and that's before accounting for expiring federal subsidies. Once those enhanced subsidies expire, some unsubsidized enrollees could see their actual costs more than double. Average out-of-pocket premiums for enrolled consumers have already jumped nearly 60% in a single year, largely because those subsidy enhancements have started phasing out. Average deductibles have climbed sharply too, pushing affordable healthcare further out of reach for exactly the people who need it most. Here's the mechanism that makes healthcare insurance specifically get worse over time, in a way that's different from cars or homes. As premiums rise, healthier people start making a rational choice. They drop coverage entirely, or they shop for cheaper, thinner plans with less protection. That leaves a smaller, sicker, costlier group of people still enrolled in the more comprehensive plans. Insurers respond to that shift by raising prices again, specifically to cover that riskier remaining pool, which pushes out the next healthiest group of people at the new, higher price. Economists have a specific name for this pattern: the death spiral. Rising premiums push out low-risk customers. That raises the average risk of everyone left in the pool, which raises premiums again, which pushes out the next group of low-risk customers. Round and round it goes. It's not a conspiracy run by some room full of executives twirling mustaches. There's a real historical parallel here worth knowing. Small business health insurance markets went through a version of this decades ago. The Affordable Care Act tried to fix it with mandates and subsidies designed specifically to keep healthy people in the risk pool. Those mandates have weakened over time, and the subsidies are now shrinking too, which means some of the exact same spiral dynamics that policy was built to prevent are starting to reappear. It's just the math of risk pools running in the wrong direction once it starts. And that death spiral logic explains something else too: why coverage keeps shrinking while prices keep climbing across all three categories at once. Insurers manage their own risk on two levers, not just one. Price is the obvious lever, coverage is the quieter one. Raise deductibles and the insurer pays out less per claim. Add exclusions and certain kinds of damage simply aren't covered anymore. Narrow the definition of what counts as a covered event, and fewer claims qualify in the first place. None of these moves show up as clearly as a price increase does, but they have the exact same effect on your actual financial protection. You pay more, and if something actually goes wrong, you're covered for less of it than you would have been a few years ago. So you're not imagining any of this. You are paying more for less, and there's a specific, traceable reason why in each of these three categories. Now, to be fair to the insurance industry for a moment, this isn't purely a story of companies squeezing customers for no reason. Insurers themselves are also absorbing real cost increases, not just passing along padding. Reinsurance costs, the cost insurers pay to insure themselves against catastrophic losses, have climbed sharply industry-wide. Litigation costs and legal settlements tied to claims have also been rising in ways that show up directly in pricing models. Some companies genuinely have lost money in specific high-risk markets. That's part of why they've pulled out of those markets entirely, rather than staying and raising prices indefinitely. There's also a technology shift underway that could eventually help, at least at the margins. Insurers are increasingly using AI for three things: assessing risk more precisely, speeding up claims processing, detecting fraud faster than manual review ever could. Some homeowners can now get discounts for taking proactive steps, installing smart leak detectors, reinforcing roofs against high winds, anything that measurably reduces their own risk profile. That's a genuine, if modest, source of relief for people willing and able to invest in it up front. None of that fixes the underlying trend, but it does mean this isn't purely a story of an industry acting in bad faith. There's a policy debate happening around all of this too, worth understanding, because it shapes what might actually change. Rising costs have pushed some lawmakers to consider price caps on insurance premiums, particularly in high-risk states. Most economists who study insurance markets see a problem with that approach. Price caps don't make the underlying risk disappear. They just make it unprofitable for insurers to cover that risk at the capped price, which tends to push even more insurers to leave those markets entirely, rather than staying and losing money on every policy they write. That's exactly what's already happened in some high-risk zones, even without formal price caps in place, simply because market prices already made writing new policies unprofitable there. So the tension is real, and it doesn't have an easy answer. Consumers need affordable coverage. Insurers need prices that actually reflect the risk they're taking on. When those two needs can't be reconciled in a given area, someone eventually loses. Either the consumer paying prices they can't afford, or the insurer losing money on every policy, or increasingly, entire communities losing access to coverage altogether. So where does this actually leave you sitting with a renewal notice that just went up again? There isn't a dramatic single villain to point at here. There's a slower, more structural story instead. Every part of your life that involves risk is being repriced at the same time. Your car, your home, your health. An industry simply passing its own rising costs straight through to you, layered with a self-reinforcing dynamic that makes the trend harder to reverse once it starts. Climate change is making homes riskier to insure. Technology is making cars more expensive to repair. An aging, increasingly expensive healthcare system is making medical coverage costlier every year, regardless of your own personal health. And once premiums start rising, the people most able to opt out do exactly that, which pushes the remaining pool's costs up even further. None of these four forces is going away anytime soon. Construction won't suddenly get cheaper. The climate isn't reversing course. Medical technology keeps advancing, and advanced treatment tends to cost more, not less. And once a risk pool starts losing its healthiest members, there's no easy way to lure them back in, short of genuinely lowering the price, which requires lowering the underlying cost first. Unless something structural changes in construction costs, in climate trends, in how healthcare itself gets priced, this isn't a temporary spike you just have to wait out. It's the new baseline. And every bill you open from here forward is going to reflect that.